What are some of the differences and comparisons between the bonds and the money market funds, and which option should you opt for whenever you want to invest or start investing? Ladies and gentlemen, I'm going to compare 7 different major areas between the bonds and the money market funds, and I will use the most basic language so that anyone at any particular level in investment can get to understand clearly. In summary, I'm going to compare the interest rates, the minimum deposits that are allowed for you to get started investing in this, the investment term or duration, the safety or the risk that your money is exposed to, the liquidity, and which is the ability to withdraw, and what are they suitable for, and finally, how do you get started investing in each of these. And this is one more reason why you should press that subscribe button, because with every new subscriber, the content in this channel keeps getting better and better. So just to be clear, money market funds are investment accounts that are managed by a fund manager, bringing together money from different investors, a pool of resources, and then makes decisions on the best places that they are going to invest this money to get a good return. They are regulated by the Capital Markets Authority and are strictly invested in safe, short-term money instruments. The bonds, on the other hand, are money that will loan to the government to help it carry out its mandate or expenses, and in return, they give us an interest throughout the term. So this is done through the Central Bank of Kenya, or the CBK. Now, the first comparison is on interest rates. The bonds do not have the same interest rate for each and every bond. So each rate is determined during the auction of the bond. We have seen very good interest rates from the bonds recently, and some which include the infrastructure bond the other day was giving over 18% return on investment per year. But then the average return on bonds usually ranges between 14 to 17%. One more thing about the interest rate is that it is fixed. It does not change. So whatever has been agreed upon during the auction, the same remains in force throughout the term of the bond. The interest rate is paid out twice in a year, that is every 6 months. So the interest rate given is subject to taxation, which is income tax, and for bonds which are 10 years and below, the tax rate is 15%, and for those which are more than 10 years, they are taxed at 10%, with the exception of the infrastructure bond, which up until now has been tax-free. And now, when it comes to the money market funds, the interest rates, they do vary from one company to another, and this entirely depends on the investment strategy and the decision making of the fund manager. According to regulations, the fund managers are restricted to where they can invest the money and to which percentage of the total funds under management that they can have invested in one particular instrument. The interest rates currently average at above 15%, with some fund managers giving actually above 18% return on investment right now. So interest is distributed daily, which means it is reinvested and therefore bringing about the compound interest effect. This simply means that as soon as you deposit your money today, by tomorrow you will be seeing some change in your balance, and that you don't have to wait until the end of the year to get your returns, or end of the month, or the end of the 6 months. But just like the bonds, there is a 15% withholding tax on the interest that is earned. The interest rates on the money market funds are not permanent, by the way, so therefore they keep on changing from day to day depending on how the instruments are performing in the market. However, the changes are not drastic or volatile, that one day they'll be down and then the other day they'll go all the way up. Second comparison, what is the minimum deposits that are allowed to invest in each of these instruments? The bonds allow a minimum of 50K, although the government is working on this platform that they had started known as the Emakiba, and these will open up so that people even with less amounts can be able to bid, but currently it's 50K. The minimum deposit on MMFs on the other side varies from company to company, which you can be able to open an account with as low as 100 bob. It therefore depends on which company you intend to open your money market fund account with. So make sure you inquire this before you get started. The other thing that you need to know is also how much is it that you can be able to top up at any given time. And third, what is the investment term or duration that you're looking at in both of these two? The bonds start with 2 years to to a 30-year term limit, and it depends on the bond that has been floated. So it is important for you to find out what is the bond term before you put your money into it. The money market funds on the other side do not have a limitation or restriction on the timeline that you can have your money invested. It all actually depends on your goal, the expectation that you have. So if you want to save for 3 months or you want to invest for 10 years, it is entirely up to you. And you can as well plan to save for 5 years and then change your mind halfway, and you won't get any penalties or forfeiting of interests. Fourth, the safety of your money or the risk that is involved. I would like to first state that there is no investment that does not have an element of risk involved, and whoever is telling you that this option has zero risk is such a big liar. This includes putting your money in the bank or in M-Pesa. The difference is the level of risk that you are exposed to. From past performance, we have not had a situation where the government has defaulted or failed to pay back money loaned to the government through the bonds. So basically, we can say that the risk is too low, but this does not mean that anything cannot go wrong anywhere in the future. Although this means that by the time we get there, the country could have probably gone bankrupt and everything collapsed, which I leave for you and me to guess if that will ever happen. When it comes to the money market fund on the other side, they have a structure that keeps the investors safe. To start with, it is categorized as low risk. What many gurus won't tell you, by the way, is that some of the money that you have in the money market fund is invested in the bonds and the treasury bills. The other layer of security when it comes to the money market funds is the structure where the fund manager who is making this decision is not in a position to withdraw the investor's money and disappear with it, since there is a custodian who is responsible for the safekeeping of the money before it goes to the investments. And this custodian has to be a bank. And on top of that, there's a trustee who ensures that the rules are played by the book, and also to keep an extra eye on this investment and what is going on. Now, all these things have been put in place to minimize the risk that the investor is exposed to. The fifth comparison is on liquidity and withdrawal of your money. So to start with, it is very hard for you to withdraw money invested in the bonds once the term has started, unless you go and trade it in the secondary market, which could mean you are not going to get the full amount that you had invested, depending on how the performance is at that particular time. This therefore means that in case of an emergency, this is one investment that might not rescue you. On the other hand, the money market funds are very liquid, even though some companies have come up with ways for you to be able to lock it for a given period of time, especially if you have a problem with discipline. But majority, they are liquid and your money can be accessed within 48 hours or even instantly. Now let's look at what are they each best for. The bonds offer you a fixed income over the term of the investment or over a given period of time. And this means that every 6 months you'll be receiving a specific amount which does not change up or down no matter what happens to the economy. With this, you can have a very predictable income. So for someone that needs a very predictable income that withstands every changing economic times, this could be the solution that you're looking for. It is also best for someone that has some money that they do not intend to use anytime soon and wishes to get a passive income from this money over a given period of time. The problem with this is that you cannot do any top-ups to your money. Therefore, your money does not grow in any way unless the interest that you get to invest it elsewhere. Therefore, at maturity, whether it's 10 years or 30 years from now, you will receive back the same principal amount that you had deposited, whether it's 1 million. And remember that the value, considering the inflation rate at that particular time, it might not be the same value of that money right now. So when it comes to the money market funds on the other side, it is a very good place for you to accumulate or do savings towards a specific goal while your money is earning an above inflation return. It is also the best place to build your emergency fund, which can be very helpful, by the way, in case of an emergency. With the money market funds, you can also earn a passive income, and you can be able to get a monthly income, by the way, from the return on investment. And above all, you can do top-ups and withdraw in case you have an emergency. So in conclusion, how can you start investing in each of these two? Before I tell you how to start investing, as you have seen already from the comparisons, these two investment vehicles can help you achieve two different purposes. So it's good for you to consider which one to go for based on the specific need that you have and the goal that you have in mind. So in summary, the bond fund gives you a long-term investment whereby the money market fund can allow you to have both long-term and short-term, and therefore it is good for you to diversify, if you're in a position to, depending on the ability that you have, the money that you have, and the goal that you have in mind. For the bonds, you will need to open up an account or download the CSD app, which is the platform by CBK to help you bid on the treasury bills and the treasury bonds. This is an application that you can actually download from your App Store or Play Store and get started right away. But for the money market funds, choose your preferred company out of the available ones in the market, and most of them can open an account instantly, either online or through downloading their application. But there are also some companies which are still very old school, which you have to engage either an intermediary or an agent or walk to one of their company branches. I will leave some of the links which are going to be very helpful in the description below to help you in case you want to get started opening an account either with the CSD for the treasury bills and the treasury bonds, or if you want to open some of the money market fund accounts that are available in the market right now. One more thing, do not rush to diversify when you are still accumulating. First, start with accumulating, and when you have a sufficient amount that you feel like, now I think it's time for me to diversify, then go out and diversify. But until then, baby steps first. Start accumulating your seed and get ready for the time to multiply it when it comes. Thank you so much for watching. Please leave your feedback below if there's any topic that you'd like to hear me talk about, and please don't forget to subscribe if you're yet to, and like, and above all, I can't wait to see you in the next video where the learning shall continue. Let's break the poverty cycle.